Thank you for watching Investing Basics, a good place to start. My name is Mark Edwards, and I am a financial counselor with Homestead Funds. Today, I will discuss a few fundamentals about investing to pump up your financial knowledge and confidence, as well as help you conquer what I call the number one enemy of investment decision-making, your emotions. When you hear the word investing, what emotion comes to mind? For most of us, the answer to that question may be fear. Fear of losing our hard-earned savings in a market downturn. Fear of not investing enough money to reach our goals, such as retirement. Fear of not knowing where to begin, which is itself based on a fear of not understanding basic investment concepts. Few of us studied how to invest in school. What we do know about investing, we probably learned from our parents or possibly our friends. But that's all right, because today we're going to demystify the topic of investing by introducing a few key concepts and tips so you can make sound investing decisions to help accomplish your financial goals. Investments are typically grouped into three major categories referred to as asset classes: cash, bonds, and stock. Each of these asset classes serves a different purpose or goal. An example of a cash investment is a savings or money market account. Cash is best used to address short-term goals, such as creating an emergency fund, buying a vehicle, or making a down payment on a house. You might think because cash-type investments offer a relatively stable value that they're safe. Over the long term, however, cash investments can't keep up with inflation. Inevitably, by staying invested in cash, only you're locking in a loss to inflation. Because of its relatively low rate of return, cash is not particularly useful for addressing long-term goals, like saving for your kids' education or funding your retirement. For that, we turn to the next two asset classes, bonds and stock. Bonds are probably the most misunderstood form of investment. Think of them as a loan to some entity, a government or corporation. In return for using your money, the government or corporation will pay interest and eventually, when your bond matures, your original investment back. Remember when your grandparents or aunt and uncle gave you a U.S. savings bond for your birthday, wedding, or another significant event? By purchasing a savings bond for you, they were giving you a gift and giving Uncle Sam a loan. When you make a loan, you typically expect something in return. That's called interest. With a savings bond, your grandparent purchased the bond at a discount to the amount printed on the bond or face amount. If you hold the savings bond for 20 years or until the bond matures, you'll receive the face amount, the original amount your grandparent paid plus interest. If you continue to hold the saving bond, you'll continue to earn interest for another 10 years. Corporate bonds work a little differently. Corporations issue bonds to raise money for reasons like building a new plant or purchasing equipment. Corporate bonds are issued at their face value and usually pay interest at a stated rate twice a year until they reach maturity, typically in 30 years, when you receive face value, your original investment, back. You can also purchase bonds after they are issued because they are traded publicly. The price of a bond fluctuates depending on interest rates. If interest rates rise, bond prices typically fall, and if rates fall, bond prices rise. By holding bonds, you can receive not only periodic interest payments, but also experience an increase or gain or decrease, loss, in value. It's important to note that most of the time, the change in value is relatively modest. Bonds usually experience a higher rate of return than cash investments, but still may not outperform inflation over the long term. Historically, to outpace inflation in the long term requires an investment in stocks. Stock represents ownership or equity, shares in a company. When you buy shares of a company stock, you are literally buying an ownership stake in the company. Companies issue shares of stock to fund research into new products and fuel expansion plans, like buying equipment and machinery. The value of your investment increases when the share price of the company stock you own rises. Some companies will also return a portion of their profits to shareholders in the form of periodic dividends. Over time, stocks have been shown to outperform an investment in cash-like investments or bonds. Of the three asset classes, only an investment in stocks has demonstrated the potential to outperform inflation. Determining the mix of cash, bonds, and stock for your investment portfolio requires evaluating your goals, time horizon, and risk tolerance. As is true in life, risk and reward go hand in hand with achieving your investment goals. If you invest too aggressively for a short-term goal, for example, buying a new vehicle, you may succeed if the markets go your way, but you also stand a good chance of missing your goal if the markets take a sudden, steep decline right before your planned trip to the dealer. On the other hand, if you're saving for retirement and put all your hard-earned savings in a money market fund to guard against a potential loss, you may miss your goal and be forced to extend your career and reschedule that planned retirement trip. No matter what your goal or when you might need your money, being true to your risk tolerance is of the utmost importance when it comes to investing. Why? If you have a relatively low tolerance for risk and invest too aggressively, what will you be tempted to do if the markets go against you? Possibly sell your stocks in a down market, locking in a loss? At the very least, you might lose a good bit of sleep. In the midst of a crisis, it's just human nature to shorten our time horizon, lose sight of our long-term goals, and quite possibly do the exact opposite of what we need to do: stick with our plan. Fortunately, there are tools we can employ to lower risk and volatility and maintain our long-term vision, keeping our eyes on the horizon. Among these are diversification and rebalancing. We'll introduce the concept of diversification here, but leave the topic of rebalancing for a future video. Growing up, we may have heard the phrase, "Don't put all your eggs in one basket." Well, the same holds true for investing. For the long-term investor, to lower risk, it's better to spread your investment across several different asset classes. One particular investment vehicle that is ideally suited is a mutual fund. A mutual fund is a company that pools together money from investors to buy a basket of investments, which is invested by a team of financial professionals. Fund types can be mixed and matched to help you achieve your financial goals. A few of the more common types are money market funds, bond or fixed income funds, stock funds, and balanced funds, which invest in a mix of stocks, bonds, and other types of investments. Diversification is literally baked into a mutual fund. For example, instead of investing in just one or two companies, a stock fund gives you tiny slices of many companies. And because you're pooling the financial resources of many investors, the costs are usually much more affordable than if you invested in individual stocks yourself. Another great benefit of investing via a mutual fund is that you engage the services of financial professionals, often a team of analysts and portfolio managers. They do the research and analysis so that you don't have to. Finally, a mutual fund allows you to buy or sell shares of the fund on any days the financial markets are open. There is no free lunch with investing. All investments have expenses. With respect to mutual funds, these expenses cover the costs of trading securities, portfolio management, accounting, record keeping, postage, bricks and mortar, and other necessary services. While you wouldn't want to choose an investment, including a mutual fund, based solely on its price tag, if all other performance factors are equal, a lower cost mutual fund will outperform a higher cost mutual fund. Let's spell this out for emphasis. All other factors being equal, how long you hold the fund, return, the amount invested, you'll make more money in a fund with a lower expense ratio than a fund with a higher expense ratio. And that difference can be substantial. Just how much of a difference? Check out this chart, after reading the fine print, of course. Simply stated, the less expenses you pay, the more money remains in your pocket. And by the way, you can find the expense ratio for a mutual fund in its prospectus. This illustration is for educational purposes only and is used to demonstrate a mathematical principle. Expense numbers chosen for this illustration do not represent any investment or fund. I would be remiss if I didn't leave you with a few tips for successful investing. Keep them in a safe place and refer to them often, especially in times of increased market volatility. Tip number 1, create a plan as a roadmap to achieving your financial goals within your time horizon and in keeping with your risk tolerance. If you don't know where you're going, any road will take you there. Be sure to revisit your plan at least once a year. Adjust your course if your goals have changed. Tip number 2, evaluate your investments. Adjust your allocations based on your current goals. Be especially mindful of taking on too much risk over time. Trim excess risk by rebalancing. Falling behind? Consider adding more fuel through increased contributions and savings and tweaking your allocations. Tip number 3, making abrupt mid-course corrections due to volatility alone may slow you down or even keep you from reaching your financial goals, your ultimate destination. Tip number 4, remember that it's time in the market, not timing the market, that helps with your ultimate destination, fulfillment of your investment goals. Please visit our website at www.homesteadfunds.com to learn more. I urge you to visit the Guidance Center, where you can pick a path and decide what goal, account type, or mix of funds may be suitable for you. Once you've opened an account, you can then log in, check your account balance, make transactions, set up automatic investing or rebalancing of your accounts, and anything else you may need to do to monitor your portfolio. Thank you for your time. If you would like more information regarding investing basics, please give us a call at 1-800-258-3030, option 2, or email us at invest@homesteadfunds.com. We look forward to hearing from you. Please take a moment to review our disclosure language.